Welcome to Hudson's Financial Planning Education Series. Hudson's history is about educating and teaching financial concepts to all our clients to provide them with the ability to make informed decisions about their financial journey. Our vision is to inspire for a brighter financial future. We hope that our education series of videos helps you get inspired to take action to start building your enough.
Hello and welcome to the education series, Why do we need to complete a risk profile questionnaire? One of the most common questions we are asked in our day-to-day working life as a financial planner is, why do I need to complete this questionnaire? Why do you feel that you need to put me in a box? Our answer, we're not trying to put anyone in a box. However, we do need a guide as to how well you sleep at night when we place your hard-earned capital into the market. A common tool that is used across the profession is the Risk Profile Questionnaire. It is used to understand your risk tolerance, essentially the sleep test. How well will you sleep at night knowing your capital is moving up and down with markets? It tests your risk capacity. Simply, it is how much risk you really need to take to meet your financial objectives. Ultimately, investing is not just about numbers and financial trends, but also an understanding of human behaviors and their mind. That is, how we think about investing, our cognitive biases versus our emotional biases. We can think rationally, but emotions can take over, which may cause us to be irrational. This overall concept falls into behavioral finance, which is becoming a large component of the role that your advisor plays to help you understand how you think and feel about money, which then becomes another component to formulate an investment strategy to match your risk tolerances and capacity. The actual risk profile questionnaire is generally used as a tool in the first instance to gauge your overall risk tolerances. It's generally a series of questions, some of which may seem like we're asking you the same thing several times. The profiles are then usually scored, which then takes away the investor's own bias, which results in the investor being placed or fall into a category. Example, a balanced investor, a growth investor, a high growth investor, or even a conservative investor. Further conversations are generally undertaken between the advisor and the investor to identify what biases that may be relevant. But above all, it is a very important step, and it needs to be considered when constructing a portfolio that matches the investor and their needs best. We all have biases, but have you ever wondered what biases you may have when thinking about investing? We're going to discuss some of the more common ones we come across. The first one, anchoring bias, whereby we place too much importance on the first piece of information we receive about an investment. For example, we purchase a stock for $50. The value drops to $30, but our tendency is to wait until it reaches $50 again to sell. But this is not always the best strategy, as it might never reach its original value again. Herd mentality. Ever felt tempted to buy into the latest hot stock because everyone else seems to be doing this? This is what we call herd mentality. But remember, popularity doesn't always guarantee profitability. As many have learned during the dot-com bubble of the late 90s, following the crowd can sometimes lead to significant financial loss. Did you know the dot-com bubble between 95 and its peak in March 2000, investments on the Nasdaq Composite Stock Market Index rose 800%, but only to fall 740% from its peak by October 2002, giving up all its gains during the bubble. 3 more biases. Loss aversion. We humans generally dislike losing more than we like winning. This can lead us to make investment decisions based on fear of losses rather than potential gains. For example, avoiding a great investment opportunity because its initial volatility makes you fear a loss may prevent you from achieving a longer-term gain. Availability or recency bias tends to make decisions on readily available information on recent events. For example, if you hear news of a stock recent stock market drop, you might be inclined to sell out of fear, even if the overall long-term trend of the market is upward. Overconfidence leads us to believe we can outperform the market based on our own intuition. For example of this may be excessively trading stocks. Believe that you have the golden touch, while frequent trading often leads to subpar investment returns. Recognizing these behavioral biases can be the first step towards better financial decision making, but it doesn't stop there. Working with a financial planner can help you navigate these biases and maintain a disciplined approach to investing, tailored to your individual financial goals and risk tolerances. We are here to guide you on your investment journey and help you avoid these common pitfalls. Let's continue to learn, grow, and build a solid financial future together. Fun fact: there are over 180 cognitive biases that have been discovered to date on the Cognitive Bias Codex. Which ones do you have? Warren Buffett's teacher at Columbia University, Ben Graham, is famous for saying, "The investor's chief problem, and even his worst enemy, is likely to be himself." So next time your financial planner asks you to complete a risk profile questionnaire, or even redo one every 3 years to test for any changes in your risk tolerances, or when there is a major change in your situation, you should now, hopefully, will understand the why behind the request to complete the questionnaire.